everyone, and welcome to today's webinar, How to Invest in Uncertain Times. I'm Tom Wilson. I'm one of the product specialists here at InvestSMART, and I'm joined again by Evan Lucas, our Chief Market Strategist.
Hello, Tom. How are you?
Very well.
It's obviously very hot in here, so we thought new spring, summer day that we'd get a bit rolling the sleeves up for what is going to be a big webinar, because we understand right now that the biggest questions out there in terms of what we get back from your feedback is how are you navigating this current scenario? How do you navigate what is a very tricky period? We are about to go through a whole heap of geopolitical issues over the next sort of couple of days. You then also look at the future of what 2023 is going to look like, and the big unknown question, and I know it's already a question, Tom, we've got, is around, what does inflation mean for us in 2023?
Yep.
How do you position for it? What does it mean for policy? What does it mean for all those kinds of things? And we want to talk about that because the psychology of this all at the moment is really tough. It is really, really tough, and we are fully aware of that. So just before we get onto it, as always, everything we do in this is general in nature. None of it is taken as any form of advice. We at InvestSMART, we don't know your personal scenario, therefore none of it should be taken as any form of advice at all. Normal disclaimers. What I want to say though, before I go any further, because this seminar is about how to basically navigate those periods, just want to roll off a couple of stats for you though, just to remember why looking very short term is the wrong thing. So the last time you and I sat here, Tom, we were talking about September and how awful September was. October was the best October it's been since 2011 in Australia. It's the best October in the States since about the mid-90s. You're talking about an 8.5% upside in October.
Yep.
And yes, as I spoke about last time, it was because dividends for us here in Australia were coming back in. There was also this, it was almost a self-fulfilling prophecy coming from the States. There was a big note out from Goldman Sachs, and they were talking very clearly about the idea the S&P was going to go to 4,000. And it was almost like it was just going to happen, and it did. There will be questions in November because already, as we've seen, the US Federal Reserve isn't changing course, and nor probably should they be. They are still going pretty hard. Inflation is, as we've just discussed, a topic we're going to have to deal with. So it's already started to ease off, but it just shows you that volatility is not just a downward thing, it's an upward thing as well. So you've got to also understand that the psychology of it is that I'm trying not to lose money, but all of a sudden don't get caught up when the market goes bang and takes off on you and go, oh, I've missed it. I promise you right now, there is no missing or getting into it. It's about understanding that time in the market is the right thing. Don't get caught up. Don't get caught up with the exuberation of month to month, week to week, day to day changes, because that is what we are involved with. It's basically like being back in sort of 2020 or going back to 2015, 16 or back to 2010, 11. I think that's sort of more what I feel this is. Definitely not the GFC. So understand that this is not like 2007, 8, 9. It's not like that at all. This for me feels more like 2010, 11, Euro crisis sort of stuff, all that. That's sort of how I feel it is at the moment.
Yeah, I mean, we'll definitely talk about market timing and time in the market.
Time in the market, all that kind of stuff.
All these fantastic sayings. You can actually ask questions during the webinar. So we've actually taken a lot of questions when everyone signed up, which is fantastic. And we'll try and get through as many as we can. But on the right-hand side of the GoToWebinar screen, if you're on GoToWebinar, you can ask a question. There should also be an area on YouTube as well where you can ask questions.
And on that, welcome to you on YouTube. This is our first time of doing this. We hope that you're liking the new way of coming to it. We're trying to modernize and get involved and get up and running. Other thing that we're doing with this is that it is all recorded as usual. We're also going to start trying to bring it to you from other social media channels. So it will come to you through Instagram, it will come to you through LinkedIn, etc. as well. So with that, I think because of what we're doing, let's sort of jump into the questions, Tom. Let's really go through what your main concerns are in this period, because that is what this webinar is about. It is about, how do you invest in volatile times? How do you invest in uncertain times? It's all going through in terms of how it is. So with that in mind, I'm going to take the first one because there was a couple of questions that we saw that I think need to be answered sort of straight off the bat.
Yeah, there's quite a few here. If you wanted to hit one of these ones so far, I mean, there's a question here talking about building up resilience for market swings with certain portfolios, active investing ETFs opposed to passive.
Yeah, so that's probably the big question, right? So the reason I say that is that came, I think, from Ron, if I remember, or Joy. That question is probably part and parcel with exactly how people experience this period. And that is, do I try and, actively manage my portfolio, trying to be nimble, trying to move in and out, trying to sort of choose X, Y, Z, all of those kinds of things adds to a level of management that requires an incredible amount of time of your own personal numbers. By all means, please have a very good look at doing active management. I think you need to be aware, though, that when active management is what you're going down, there is going to be a level of disappointment that you need to accept. And what I mean by that is that you are going to get scenarios where you will do well, but you'll also do poorly. And that's the hard thing. That's why if you look at active managers, they are very good at what they do. They spend almost every waking second during these periods doing their life, doing what they are trying to do. So if you look at what the intelligent investor, which is part of InvestSMART, is doing right now, someone like Nathan Bell, he is actively managing the portfolio, and he is working overtime in terms of trying to find not just the opportunities, but making sure that the opportunity that he does have is working in a positive fashion during volatile times. So if you think you can do that, by all means, we would never tell you not to do that. I think the other way to look at it from the passive side is that the passive funds are run in a way that are trying to replicate the groups they're in. So whether it's the conservative or the balanced or the growth, high growth, etc. And we've spoken about this many times. They are representing what, the 3,356 funds in Australia that are classified as balanced. So we just take that, find the median position and allocate it that same way to making sure that your fixed income, your international, domestic equities, your property, your cash are allocated to what the group as a whole does. So the reason I ask that is that there's been questions at us at the moment about particularly the high growth. So if you have a look, the high growth has moved slightly more towards cash, and there has been some pushback about that. The reason it's moved that way is because that's what the group of high growth performing assets that are considered those funds in Australia have moved towards. So they're now sitting at about 8% of their portfolio is in cash. I understand that some of you want higher than that. So this gets back to that question, active, passive, you're more than welcome to do a hybrid, right? Because again, this is all about what you want. We can offer you as much as we can, and we try to give you as a broader brush of products to fit the risk profile that you want, the weightings that you want, but in the end, you are you. And if you need to therefore think, okay, my high growth isn't as high growth as I want it to be, then that is your direct equity answer. So I remember when that question came in, and I was thinking about this last night, actually almost dreaming about it.
Yeah, nightmare. Is it a nightmare?
Yeah, it's sort of a nightmare, maybe a nightmare. I don't know, but it's about understanding that what is right for you is the only answer. And we here would tell you that as well, that the answer that is right for you is the right answer. So if that means you want a combination of active and passive, or you just want passive, or you just want active, that is the answer that needs to be taken to what you're going to do. Because in the end, the level of excitement, the level of appreciation, or the level of disappointment and the level of negativity can be governed by yourself. And I think that's the most important thing, because if you've got control of your finances, you've got control of your investments, you're going to be in a much better position. We are here to help. We're here to give you as much as we can. But in the end, you are the best person to know what's best for you.
And it comes down, there's, I guess, some practical approaches as well in terms of strategy. We talk about passive and active. There's strategies out there like core and satellite. And I know we touch upon this in the InvestSMART bootcamp, and it does talk about what is active, passive, which you've run through already, which is fantastic. But also strategies such as that. Again, we can't tell you exactly what percentages you should have of each, because it's dependent on your situation, your goal, time frame. But
that's it. And so possible. Taking that further, this whole premise is how do you navigate the scenario, right? So that also means that if you have a core and satellite, you can slide up and down the risk profile. So your core holdings should be able to basically look through short-term volatility, like I explained at the start of this webinar, and they are there to basically catch the upside, but also buffer you on the downside. It's your satellite and your satellites, plural, that you can move that may be able to grab more advantage or less advantage. And when we look at satellites, what we're saying by that is that they can be single asset classes, they can be single entities, they can be single stocks. It doesn't matter. It depends on what you want to do. So one of the questions that came in was, right now, should you be investing in international equities more hard? And then the part of the question that was premised with that, considering the inflation that is coming. So that question in itself sort of answers what we've been talking about here, is that clearly you know that you want to invest overseas, which is a good thing because not enough Australians are invested overseas. International equities over time have outperformed the ASX pretty consistently over the last sort of 2 decades. But, and it is a but, that outperformance comes with a higher level of risk and a higher level of volatility. So the question is basically saying that in another way, is that inflation is coming. I'd actually argue inflation isn't coming, it's here, right? It's not about waiting for it, it's already here.
It's already happened, yeah.
And we are going through that process. You can see, particularly if you're under the age of 45, you're about to go through a period in your life that most, in fact, all of you haven't experienced, which is that you may be forced to start thinking about making choices you didn't ever have to do, which is your essentials, health, education, food, fuel, transportation, versus your discretionary spending, things like travel, things like, you know, going out, things like apparel buying, etc., where you have to go, actually, I can't afford to do the discretionary stuff. So that's inflation, and that's what and it's why inflation's a horrible thing. It impacts your purchasing power. It's why central banks are trying to slow it down to try and make sure that it comes back to a level that is sustainable and more affordable longer term, so that your purchasing power can keep up with price increases. So by all means, we would say this, still keep looking internationally. And the reason I say that is that the international pullback has probably happened. I mean, you look at Europe, you look at the US, you look at Asia, the pullbacks already happened. The three are very different. Asia at the moment has realistically the big elephant in the room, or the big dragon in the room, which is China. Their COVID zero policy is clearly impacting sort of almost artificially markets. So if you look at something like IAA, which is the China A50 ETF, it's really underperformed because it's basically following, you know, what comes out of Xi Jinping's mouth, and what his policy is moves that. Then you look at somebody like what's going on with, you know, IVV, which is the S&P 500, another question we got, and it is tracking very clearly to the idea that 2023 will be difficult for the US, but there is a chance that it could actually sort of start to break out midway through the year, and there's positioning to that, and you can see that already. So it's fallen, it's in a bear market, it's fallen over 23.5%. Some might see that as a longer term opportunity. So all those questions sort of answer that idea that the international opportunity is there, as long as you're mindful about the risk and you're mindful about your time frame.
Yeah, because I was definitely looking at one of the ETFs we use in our portfolios. It might have been IVV.
Both IVV and IAA are in our portfolios.
I think over its, was it a 5 or 10 year period, it's gone up 43%.
Yeah. So, yeah. And this is why when we do this, we've got to be very, very mindful about talking even in years. So this year is and has been tough. There is no escaping that. That is true. But if you add 3 more years to that, including COVID 2020, so from 2019 to where we are here, the S&P 500 is almost up 46%, including what's going on right now. 19, 20, and 21, the S&P 500 was averaging about 21 to 25% year-on-year increases. That's incredible. That is also not normal. Like, that's what also needs to be put out there. So your expectations get skewed. Your expectations in 2020 and 2021 is that, oh, these 20% increases will keep coming. Your expectations in 2022 has now been skewed to the downside, and you're running away from it, if you understand what I mean by that term. So that's why when you look at this year in isolation, it will make it very, very difficult. So again, part of the answer to this whole question today is, how do you invest in uncertain times? Understand that the uncertainty will end.
Yep. Understand
that over time, the return of markets will be there. I mean, COVID, GFC, Asian financial crisis, 87 flash crash, 80s recessions, stagflation of the 70s, Second World War, 60s recessions. I can roll them off for you constantly.
Yeah. And that's something that Warren Buffett has done in the past.
Yeah.
I know we refer a lot to, and a lot of people in investing do. It's just that he seems to come through a lot of sage advice, but he's made his mistakes as well.
Yeah. And he's a beautiful example, because again, people look at his net wealth almost like a case study in compound interest, and it looks like on a chart like this, it looks almost, you know, perfect compound interest in terms of what it is. But if you actually drill right into it, you can see his wealth does this. It doesn't, it's not this perfect exponential appreciation. He hasn't had that. He tells people that. I mean, if you look at his wealth in the 50s to his wealth in the 60s, he lost about 40% of his actual overall wealth just from being in markets and just from being invested. And what did he do? He just went cool and just plowed back in even harder. Now, that's not for everybody. That also needs to be put out there.
Sure.
And he's the exception to the rule. Like, he's an exceptional individual. Study him by all means. But he's also a great understanding that he knows that time in the market is his long-term goal. He also understands that he doesn't put all of his wealth into one area or into one part.
That's it. I think no more than 10% at least per stock that he chooses. And I was actually.
And he still holds cash.
He still holds cash.
He still holds cash.
Yep. And he sits out of markets when he thinks that it's, you know, crazy prices, everything's overvalued. He took 4 years off during, was it around just before the GFC?
Yep.
And he sat back, had his cash there, ready to go.
He also gets a lot of stick for instance, you know, not getting caught up in fads. So he was pressured quite heavily in 98, 99, 2000 about why he wasn't investing in basically .coms. And his justification was that they're not proven, and that proved to be right. Again, he did the same thing leading into sort of, you know, 2019, that he was backing away from really plowing into new world technology and those kind of areas. And again, he says it's unproven. It's not his thing. Some people do that very, very well. Ray Dalio, for instance, you know, the major hedge fund player, he does that very, very well, but he's now suffered for it as well. So, you know, upside returns also brings downside, and even the very best have that same problem.
That's it. There's a really good question actually that's come through from Damien. Thank you so much for putting this one through. And it relates, I guess, to what we're even talking about, that mismatch. There's also that Mr. Market playing. When a company has solid fundamentals and is highly profitable, the share price may still drop by negative market shifts. Conversely, a company with poor fundamentals and losing money, its share price will improve. Hence, sentiment is more important than some of the business fundamentals. And I guess this is why ETFs typically outperform direct investing net of fees. And that's a really interesting point, isn't it? Because I guess that's the whole argument, passive versus active.
So that's why it's now the most, you know, like in 2020, for the first time in its history, passive investing overtook active. And it's exactly as Damien puts it, because even if you've got a portfolio of 25 stocks, you're still holding a level of stock risk that is well and truly above an ETF. So 25 stocks versus 200 for the ASX. 200. 25 stocks versus 500 for the S&P 500. The blending that gives you with passive to mitigate that. I mean, you look at the S&P 500, the highest holding it has is Apple, and it's 4%, right? So 4% of that ETF is Apple, which is probably arguably one of the greatest, if not the greatest company on the planet. Your stock risk to a company like Apple, which is very, very low, is still only 4% of the overall percentage. So you scroll down that, you look at something like Tesla, which is, again, an incredible new age company, but its volatility and its individual stock risk is huge. I mean, Tesla has moved down 50% in the last 12 months. Meta, 70% decline. And it's because you look at someone like Mark Zuckerberg at the moment, what has been argued at him is that his discipline, his business discipline, has been lost by him continuing to plow into these virtual reality programs and the money spent on that. So again, that's market risk, stock-specific risk for a company that is and was in the top 20 largest companies on the planet, which has now fallen out into the top 100, gets removed. Again, some people will want that risk because the upsides on a Tesla, the upsides on a Meta can be incredible. And that's fine for them. But the ability and why passive investing is now so popular and has overtaken active is because it removes that. Now, that does also mean you're not going to outperform the market because you're getting it. But the market shows that over time, that's probably actually a better option. Because the other thing that comes with active, this is the bigger thing. I think we're sort of circling around this elephant, which is when do you get out?
That's it.
Right. So that is normally and behavioral finance shows us the biggest problem isn't about getting in. It's about when you get out. And again, Tesla and Meta are the great examples of people believing the story for so long that they don't know when to get out. I'll go even further back and go even simpler. I've always said this, and I'll say it, and it's still the case today. CBA is an Australian, and along with BHP to some extent, but the CBA is the Australian equivalent of all these, worse even, because people just hold CBA because of the dividend it gives you. And trying to tell an investor that maybe they should think about trimming, not selling out, just trimming their CBA, is like trying to tell them to sell their left arm. They will resist it no end. And that's the psychology of it. And that's, again, the passive investment opportunity gives you away from that. Because if it does need to be trimmed, it's done for you.
That's it.
The psychological, issue of my opportunity cost, I'm going to miss out. The CBA could get more expensive, could continue to appreciate, blah, 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 Meta, Facebook. That's removed from you.
Yeah, I think that's the benefit with holding an ETF like IOZ.
Yeah. Where
it's, all the weightings are done for you. They're kept in check with the actual ASX 200 itself.
Yeah.
If
you've got any more live questions, guys, please shoot them in. That was Damien that went on the questions. That'd be great. We'll keep working through the pre-questions, but we love the live questions. If you do have them, please jump on the right-hand side of you. You go to webinar panel and type them in there where we can. I think there was a question there, Tom, that I think you should answer about some of the administration that comes with this, because I think that's a really important thing also in this period, is that part of the strategies that help you, and I'll let Tom go a bit further, it is removing yourself, like we just discussed with passive and active. So, doing, constant responsible, investing, so dollar cost averaging. So talking about using monthly contribution plans.
Yeah, and I guess
dividend reinvestment plans. Do you want to talk about that?
Yeah, it's a good idea, because a lot of people, they ask us for strategies to try and get around this, and most of us do it with our super contributions. We're automatically adding to our super.
Forced on you, which is fantastic.
Which is good. I mean, otherwise, what would happen?
So look, super has some pros and cons to it.
Yes.
But you're right. The biggest thing about super is that you are forced to invest. It's not just saving, you're forced to invest. And so that's the other way to get through this period, is that, if you've got a lump sum sitting on the side, that's fine. By all means, if it makes you feel safer, do that. But don't lose sight of your longer term goals. And therefore, if you do have a monthly contribution plan, it removes your behavior's ability to stop you. Like, inaction is just as bad as overaction.
That's it.
So
hesitation.
If you're hesitating, exactly right. If you're going, no, it's going to get worse, it's going to get worse, you're never going to find the bottom. You're never going to find the top either, but you're never going to find the bottom, because the bottom in some people's eyes could always keep coming. And it's so easy to find a pessimistic view. Pessimism, and there's a great quote that comes out of someone like Morgan Housel in his Psychology of Money, that is, pessimism sounds like some of the most smartest thing you can, whereas optimism sounds like a used car salesman.
Yeah.
And that's a good way of putting it, because pessimism is a very safe option. Human beings are naturally risk averse, because we're trying to basically preserve ourselves. We're trying to make sure that we preserve what we have, and losing what we have is a really hard thing to take. So if you can try and remove that by, again, just monthly contribution, $100, 200, 500, whatever it is that you can afford to keep adding that dollar cost average, it will mean that when the turn happens, that lump sum will be there waiting for you, but at least you've been adding to it, that you're not missing out on the opportunity that will come when markets do start to appreciate, and you get that bottom that will come. Again, GFC, look at the bottom to where it happened. You look at COVID, bottom to where it got to. You will look at this now, and I reckon in 2025, the difference will be stark, and that will be the other argument.
And just to touch on, for those who are already invested in a professionally managed account at InvestSMART, or thinking about it, you can set up regular contribution plans in the platform. So you can nominate an amount that gets direct debited from your account every month, so automated, which is a good way to do it. Alternatively, you can set up things from your end, such as like BPay payments, so you keep topping it up. There's another question in here too, which we get asked quite a lot in the client services team about, does the PMA provide a data feed to my SMSF administration accountant? It is possible. We use a system that's called Class. A lot of accountants do use it, and we can actually facilitate some kind of data feed to your accountant. So you can definitely get into contact with us. Email invest@investsmart.com.au. Usually coming from your accountant is better because they know what to ask for and what to do. We actually tell them that they need to contact class and get a document signed, so it is possible as well. I'll just check if there's any other questions that have come through. There's a few questions, I guess, also around some alternative assets here,
Oh, yes.
which we don't really cover off in terms of, I mean, we try and, I guess, stray away from them in a sense because it's not our bread and butter. But, you know, talking about cryptocurrency, for example.
So, I mean, let's talk about it.
Sure.
Okay, because again, this whole webinar is to talk about, you know, what to do in volatile times. Cryptocurrency is the epitome of that. Right, so cryptocurrency, NFTs, all those kinds of products, those alternative, fast-moving, because there are people out there that very much are very assertive, probably bordering on aggressive in a risk profile, that love this kind of material, and that's good for them. Cryptocurrency is an incredible theory. Again, I'm going to put this out there very clearly. This is my opinion, not everybody's. I want to say this very clearly because the thing that gets to me about cryptocurrency is what exactly is it? And I've said this many, many times, and I'll keep saying this. The reason I say that is that cryptocurrency is basically just people trading something in a circle and in a closed loop. And what I mean by that is that there isn't anything behind it. There isn't any major, you know, opportunity to use it. Yes, some people say they can buy X, Y, Z with it, blah, blah, blah. But in the main, you can't really exchange with it. You can't go and buy your day-to-day things with cryptocurrency. You can in some instances, but it's very, very limited. It's not a store of value, which has been proven very clearly during this period because some people are trying to argue it's a hedge against inflation. It's a tech link. It's linked to monetary policy, and this is all very technical. You know, the cheaper monetary policy is, the higher it went, and there's an inverse correlation. So why I say all this is deliberate to show you it's incredibly technical. It has a lot of underlying innuendo, and that's probably also the correct term, to move around it. By all means, go for it if you are interested in it. My advocate is this. It is part of what I believe is called the greater fool theory. And what I mean by the greater fool theory is that if I've got cryptocurrency and I'm trying to sell it to Tom, I'm selling it to him because he believes it's going to get higher. And therefore, is he the greater fool than me? Tom then is going to try and sell it to you guys that are listening to this, going, you expect to go higher still. And it's basically this belief that it's just going to continue to get higher and higher and higher because there's nothing behind it. So in the end, the greater fool is the person that ended up holding it. So you look at those that bought it at $69,000 US a coin, right? And it's now back at 20s. And sort of started flatline. Some people are starting to say, oh, look, we finally found this point where Bitcoin is stabilizing and blah, blah, blah. Well, I would actually argue that what's happened to it is that the mania that was going into it at the end of last year has stopped, and those coins aren't circulating around. So therefore it can't move because there are people sitting out there with 40 grand per coin losses and higher on a, you know, what is a 21 million coin database. Yes, they've cleaved it and cleaved it and cleaved it. It's now a Skirkle.
I think so, yeah.
Skirkle, you know, with a cent version of it, and cleaved it and cleaved it and cleaved it and cleaved it. Still a close circuit. So this is why crypto is so hard to argue and to talk about. Those people that want to come at me and tell me that I'm an idiot, I'm happy to accept that. I really am. But why I'm saying it the way I am is to show you the complexity behind it. And it is so complex that for most people, it's certainly not something to touch.
Yeah, I mean, there is like that blockchain element which has application in some areas, and that's
the future.
It's the future, exactly right. And I think that's a good thing in that respect.
The technology underneath it, I agree,
sure,
is going to be very fundamental. But crypto, the word part of it that really annoys me, currency, is a speculation device, tool, vehicle, whatever nouns you want to use. And that isn't for everyone. In fact, it's probably not for the majority of people.
I think it just comes back to that thing again where if you don't understand it, don't invest in it. And that's what we really try hard to do with our managed portfolios, our ETFs through Intelligent Investor. We
Let's
really
get
try and explain it. Hey,
let's get off.
well, there's some really other good questions. One coming from Albie. Thanks so much, Albie. Appreciate the question, and Craig as well. And these, I can try and work these two together, I think.
Okay.
So while staying invested, some people might be building up some cash. What signs do you look for to deploy the cash? But at the same time, Albie is asking, with their portfolio with an InvestSMART PMA, how often is it actually looked at and then reweighted if needed?
Yep. So let's take Albie's question first. So Albie, we do the reweight every month. We have a team in Sydney that actually watch the portfolios every day. So they are made sure that they are weighted to the equivalent of, as I said to you, the whole consensus of those 3,356 balance funds, some 2,000 something.
It's like our benchmark.
Our benchmarks. To make sure the weightings are right, and we update them as regularly as we possibly can. We obviously do our sweeps where we take those that are doing monthly contributions, all those kind of things need to be weighted in. That is done, as I said, very much every month, and Matt, who runs that team, does that very, very well. So it is constantly being evaluated. In terms of whether or not, this is the next part of that question, I'll take it a little bit further about, is the ETFs inside it the right ones? Are we doing the correct weightings? Is it meeting your expectations? So should we be going and looking at, because the question from the last one was, do we need a hedged, used or unhedged ETFs? All of those questions. Every quarter, we have an investment committee meeting, which I sit on along with Alan Kohler, Effie Zohos, Paul Clitheroe is the chair, our CEO, Ron Hodge is there, Alistair is there as well, Alistair Davis and our head of funds, all of us are there debating that exact question. To make sure that we have a fairly robust discussion about whether or not the funds are doing what they should be doing, and so we do. Therefore, it's not active management. We are just making sure that it is giving you as close as we can get to what you want for a portfolio that is in international equities, or as close as you can get to a balanced fund. So that's probably answering to Albie's question.
So I guess even with that cash question there from Craig, it's not a case that at that board meeting you look at it and
so we should bring our cash position up.
Yeah, oops, Siri's getting involved. Thanks, Siri. But it's not the case that you say, oh gee, the high growth has 20% cash, for example. We need to get it down. We should be investing it in more Australian ETFs or in international. That's not the case at all, is it?
No. So again, it's about, is the high growth portfolio meeting its mandate of benchmarking against the high growth, basket? Yep. Yes or no?
So it's not a case of we're not reinventing the wheel.
The argument that comes with that, so that's a really good point. So the question that we're probably getting at the moment is that, is the cash component giving the best amount of return? And that will be a debate we'll have. So
yes.
Something like AAA, which is Beta Shares high cash ETF, which we use a lot, is it giving you the kind of return that you should be expecting? Yes or no?
Yeah.
Is it the best option out there? And that gets back to the four things we also look at. So the MER, so the management expense ratio, is it as cheap as we can possibly get it? Yes or no? Is it representing the index that it's exposed to as close as we possibly can? Yes or no? Is it liquid? And by that, what we mean is that you don't want to have an ETF that is really, really illiquid, because then we can't move it.
Yeah, hard to get in and out.
Hard to get in and out. It also means that it may not replicate the price correctly.
Yep.
So it can move really fast because it's illiquid. The final one is actually the price of it. So when we say that, let's use the ASX 200.
Yep.
So we get this question a lot. So IOZ and the A200 are the two ETFs out there we always get questioned.
Yeah.
The A200 on an MER is technically slightly cheaper than IOZ. The issue with it is that the price of it's about 110, 120 bucks, whereas IOZ is about 26 to 28 dollars, top of my head. Why we use IOZ is that to get the correct weighting, it's easier to use that price, because then you don't get this big block of 100.
That's it.
Rather than giving you 4 IOZs to one A200, we can give you the weighting that's better. So that's why we do it. So again, that's what we debate.
So it means more of your actual cash is more likely to be invested, because we can buy smaller unit sizes.
Correct. Yep. And actually weighted the way you want it.
So hopefully that answers the question. Of course, when it comes to the active ETFs, like the Intelligent Investor ones that Nathan Bell looks after, that's a different kettle of fish. And we've done some interviews with him even recently for the Ethical Share Fund, which we had another offer just finishing on the 4th of November. And in that case, he has the cash there, but he's also not just choosing something to invest in for the sake of it. He's still following his value investing principles. We're reaching the end of the...
To the point of this. Is there any more questions? We don't want to finish up without letting you ask any more questions, because it's so much more important to make sure that we go through this. But we are cognizant that we've now run over time. Is there any more questions out there from those that are watching? Because I think we may have reached everything we need to do.
Yeah, there's a couple other questions that did come through that just aren't directly relevant to the webinar today, but you know, it's something that we can try and touch base with you, or even refer you to other articles talking about housing and gold.
Yeah, so I mean, look, we can talk about housing, we can talk about gold till the cows come home.
Yeah.
They're probably, as you said, they're not probably applicable to what we're talking about today. We will certainly talk to you about it. We're trying to do more of it. I will probably put some individual videos out about those individual things.
Yeah.
And that's what I'll endeavor to do, is that I'll put some videos up on InvestSMART. I'll also put them up on Eureka as well, if you're a subscriber to the Eureka report, to sort of answer those questions individually, because I know they're important, particularly the property one. It's a big question that Australians always have, is
Sure.
Where's my property going? What's the value of it? How does interest rates going to affect it? Will it ever return to those levels? So I'll let you know now. I will do that as a separate video completely to answer that question, but it's not for today. With that, I don't see any more questions coming through. So
thanks so much for all the questions so far, and for tuning in today. And we're going to try and get our YouTube channel up to tip top. So we've got so much content to put there, but it's just a matter of getting it up on there. So when we do have that set up, you know, we ask that you like, subscribe the actual videos itself, give us feedback. What can we talk about that helps you? But I guess until next time, which will be next month, we'll try and do another one.
Yeah, we'll do one more before the end of the year, and then in January we'll probably do a big one to open up 2023, discuss, you know, your goals for that year and what have you. We're always trying to do a big one in January to try and get you, you know, prepared for what will be a new 12 months of thinking and how that all goes forward. But for those of you that are here today, thank you so much for joining us. As always, we really enjoy looking forward to having your questions come in. See you next month, and again, good luck with your investing.